At the end of the movie The Big Short, the movie mentions that Michael Burry is now focusing all of his trading on one commodity, water. So in this video, we're going to look at how you might also invest in water, not directly, but indirectly through funds. So let's look at investing in water in a bit more detail. In an interview with New York Magazine, Burry said that what became clear to me is that food is the way to invest in water, by which he means you grow food in water-rich areas, such as Scotland, which you can see behind me here, and then you transport it to water-poor areas. And as he pointed out in the interview, one bottle of wine takes 400 bottles of water to produce. And it's the water which is embedded in food, in its production, which Burry finds interesting. And here's a lovely graph from The Economist, which shows the volume of water required to produce 1 kilogram of various foodstuffs. It turns out that chocolate is top of the list, but meats generally also come out very high. So if you eat beef, mutton, or chicken, that has a very large water requirement. Whereas if you go for vegetables, typically the water requirement is much lower. So that's why avocados, bananas, and tomatoes are at the bottom of the list. Now, of course, we live on a planet which is very water rich, but the water which we can actually use is fairly limited, because usable water which we can drink or use for agriculture comes out of rivers, or it comes out of aquifers, which we have to pump out of the ground. And if we look at this map of water stress, and that looks at the ratio of withdrawals of the supply every year compared with the total supply, and this is based on a forecast in 2040, you can see these huge swathes of the world which tend to be highly populated with lots of water stress. And some of the greatest demand for water comes from agriculture. And there you see many emerging market countries depending on these very limited water supplies. So the forecast here suggests that in 2030, the greatest stress will be in Brazil, Russia, India, and China. So what we have here is a pretty demonstrable finite resource where infrastructure is going to play a big part. So this is a pretty strong case for investing in water infrastructure. But how can you do that? Well, unlike Michael Burry, we probably couldn't afford to buy farmland in water-rich areas. But a good alternative for regular investors such as you and I is to buy water funds. And if you look on Just ETF for European water funds, you can see that there are 4 of them listed beneath me here. And what's notable is that the expense ratio for those funds, because they're thematic funds, tends to be quite high. So I've sorted these 4 funds in ascending expense ratio, and the cheapest one is 0.49% per year. And that's the LNG Clean Water UCITS ETF. And if we look on ETFDB for the cheapest US water ETFs, these are the 5 which are listed. And again, I've sorted them from cheapest to most expensive, and the cheapest one is again quite expensive, 0.4% per year. But not all of these funds are created equal, so it really pays to dig into what exposure they give you to find a fund which suits your needs. And a very good place to start is with a fund fact sheet. So here's the fact sheet for that LNG Clean Water ETF. And we can start with a fund aim, which is to track the performance of the Solo Active Clean Water Index. Because remember, if this is a passive fund, then it'll simply be matching the returns of an index which is created by some other provider. So if you really want to understand what goes into the fund and the selection procedure for the stocks, then a good place to start will be with the actual index provider, not with the fund provider. But there are various things you'd look at on the fact sheet. So for example, you can see the fund's size beneath me here is quite big, $232 million. And that suggests that the fund isn't going to close down anytime soon. And that's because the fund is generating quite a lot of revenue for the company. 0.5% might not sound like much, but 0.5% of 232 million is over $1 million every year. So I think it's unlikely this fund is going to be closed down due to lack of interest. The currency of the fund is also important because if you're a UK investor, then you will be taking the currency risk between US dollars and sterling. So if sterling strengthens versus the dollar, it'll reduce the value of the fund in sterling terms. The domicile of the fund fund also matters because of withholding tax. So the actual dividends you receive, the income on the stocks in the fund, will depend on the withholding tax between Ireland and where those stocks are based. In fact, this fund trades in both sterling and US dollars on the London Stock Exchange. But whichever of those you choose, you'll always be taking some currency risk. And that's because it's not a hedged fund. There's no derivative in place to knock out the currency fluctuations. But it's worthwhile noting that L&G does have a sense of humour. The ticker for this fund is GLUG. And it's always worthwhile drilling down into more detail in the fund just to make sure that you're happy with what's inside it. So for example, if we look beneath me here on the fact sheet, you'll see that the top 10 constituents of the fund only make up about 23% of the fund. So it's always worth checking that it's not too concentrated in just a few stocks, because that concentration risk could be a problem if that stock falls in value. But even the largest stock holding in this fund is quite small, it's just 2.5%. Now the sector composition is concentrated in industrials and in utilities, but of course you'd expect that because of the nature of the fund. And if we look at the currency breakdown for the fund, you can see it is dominated by US companies. Stocks which trade in dollars make up over 60% of the fund. But that US dominance is true of many funds because the US equity market is simply so big. If we compare the components of that L&G fund with the one from iShares, the iShares Global Water ETF, there's much more concentration in a few stocks for the iShares fund. So you can see American Waterworks makes up 10% of the fund, whereas for the L&G fund, the biggest weight was only 2.5%. And if we add up the weight for the top 10 funds, you can see that that makes up more than half of the fund. So this is a much more concentrated fund, which depends much more on the performance of these top 10 companies. So what kind of companies will you be buying with a water fund? Well, it'll break down into these four categories: distribution of water, purification and filtration, infrastructure and services. And services is very general. It could be anything, including software to do with water management. But if you are going to be buying a fund, it's worthwhile spending a little bit of time looking down the list of stocks which you'll be buying. There may be some surprises which you may not be too happy with. So for example, this is the largest holding of that L&G fund. Now that might ring some alarm bells if you're buying this fund for environmental reasons, because perhaps you're not comfortable buying a company which is involved in heating and cooling systems. The second largest equity holding of that fund is with China Lesso Group Holdings Limited. And perhaps you're not happy investing in a Chinese company, because some people choose not to invest in Chinese companies due to China's humanitarian record. The S&P Global Water Index contains a bit of a surprise because they invest in Tetra, and Tetra Technologies is actually a diversified oil and gas services company. Water management is part of their business, but it's certainly not their core business. So if you have environmental concerns, perhaps you'd avoid funds which invest in this company. If you do want to keep abreast of what's going on in markets, but also to learn about the link between economics and investment, a great way to do that is by signing up for our free weekly market roundup. It only comes to you once a week, and I try to keep it topical and relevant. If you want to learn more about signing up for that free newsletter, then just click on the link above me and in the description below me. Now let's take a look at the historical returns you'd have got with some of these funds. This graph tracks the value of $100 invested in 6 of these funds starting at the end of 2012. Now for comparison, I've also shown the S&P 500 here, and you can see that only 2 of the funds beat the S&P over this 9-year period. That was FIW, which is the First Trust Water ETF, and WATL, which is the Lixor World Water ETF. So even though they're based on the same theme, the performance can be quite different based on the particular construction of the index. And that's why it's so important to make sure that that construction is something you're happy with. If we annualize those returns over that period, you can see that First Trust, which is the best performer, had an average return of just under 17% over that period. But even for the worst fund in this group, the return was just under 12%. And a 12% annual return is respectable for any fund over this period of time. Now, water as an investment theme has been very popular in the post-pandemic craze for equity, or you might call it the pandemania. So if we repeat that exercise where we look at the return on £100 or $100 invested at the beginning of the period, which is just at the bottom of the equity market crash post-pandemic in March 2020, you can see that that FIW fund is again top of the pack, and that fund is First Trust Water. First Trust Water has done very well, so I thought it would be interesting to try and figure out why. Beside me here you can see the stocks which are in the fund, and First Trust explains how those stocks are selected. They have to be exchange listed companies, they can't be unlisted stocks. Because this is a water fund, they have to derive a substantial proportion of their revenues from the potable and wastewater industry. But now we start to get to the interesting bit, which are the constraints for the stock selection. The stocks have to have a minimum market capitalization, so tiny companies can't be included. Plus the stocks have to have a certain amount of liquidity, so they're cheap to buy and sell. But the key thing is the weighting concentration constraint for this fund. So although it only has 36 stocks in the fund, which doesn't sound like many, it does have a modified market cap weighted constraint on those stocks. Now what the fund is trying to avoid is putting too much equity into the largest companies. So those really big companies in the top 10 ranked by market cap are only given weights of 4%, and that's much less than they'd have if they were purely market cap weighted. And for the smallest stocks by market cap, they get a weighting of 1.25%, and that's more than they'd get if you simply weighted by market cap. Now Morningstar has this brilliant portfolio feature on their website so that for any fund you can see what factors you're buying implicitly. And for First Trust Water, the tilt that you can see here is towards small caps. And that's a direct consequence of this banded weighting methodology. So by tilting to small caps, that favors growth stocks, which tend to usually be smaller. And I think that's probably the primary source of outperformance for this fund. So the performance of those water funds has been very good recently, and that might make you think that these are good investments after a correction. So it's something to put onto your crisis shopping list. But it's certainly worthwhile digging into the information documents that come with these funds, because you may end up buying something which you're not really happy with. And remember, if you do want to keep track of what we're publishing and support us, you can always do that by just clicking subscribe on our channel or liking this video. And as always, thank you for listening.